think what SME customers are demanding from their banks and how those banks can fill the gap, it's sort of quite similar to what you see on the retail side. Obviously with technology now, we expect things much faster, we expect things pretty much instantly. We expect it to be a pretty seamless process, and we hope that it's going to be pretty personalised to what we are looking for. And I think that's similar to what SMEs now and SME business owners are looking for. They want to be able to liaise with a bank that's going to take away some of the complexity, that's going to explain things in English rather than the lingo, that they're going to hopefully fix whatever problem or open their account or transact their business loan quickly or as quickly as possible. They don't want to be waiting for sort of weeks for a response to emails or to have NDAs signed, things like that. So I think the expectation has changed a lot because of what we've seen on the retail side and how technology has facilitated the interactions with other businesses.
Well, it's twofold. I think they're more demanding than before, and what they are expecting from their bank is sometimes more reactivity, more flexibility, in one word, a better customer experience. And the second thing is, if they go outside their bank, they're expecting to see something different. So maybe something longer, something more unsecured. I think alternative lender can fill a gap when they try to act in conjunction with bank financing, not to replace bank.
So I suppose the first thing is they actually need what a lot of other customers need. But it's actually important to recognize who they are. So self-employed are workers like many employees, and therefore they need the same kind of services and products that employees have. And really banks need to start recognizing that they're not businesses, they're actually more like workers and employees than businesses, and start being able to service them like that.
So I think with open banking, when you apply it to SME banking, it's one of those things. I think what we've seen with open banking on the retail side is that for the most part, most individuals still aren't really aware of it. I think there's a lack of understanding around it, and it was just sort of bad timing. I think that open banking came out at the exact same time as the Facebook Cambridge Analytica scandal. So most consumers were probably a bit weary of sharing their data and enabling other businesses to use their data. So I think if we can see more people using it on the sort of retail side, then hopefully that will flow over to the SME side. I mean, it would be hugely helpful, obviously, to have access to that information. If you look at OakNorth Bank, for example, as an SME lender, having access to businesses' cash flow, what sort of things they spend their money on, looking at their current accounts, because we don't offer those products, that would be hugely helpful. It would just help with some of the initial onboarding process and the due diligence that we have to do as part of our credit analysis. So it could be really impactful, but I think it's only going to happen if we see a good amount of usage from the retail side, and then they'll say, okay, now let's apply that to the SME side as well.
Well, I think the key piece here is the data. So self-employed are quite a diverse group across lots of different kind of professions and sectors. They have a number of kind of common attributes, like the kind of variable nature of their pay, of their income, and the fact they don't get paid for holidays. So open banking actually helps kind of understand those income profiles, understand their genuine earnings, and can actually be used then to modify and build products that are designed for that, help underwrite for credit, so actually get a real understanding of their affordability versus the traditional what is your paycheck and a letter from an employer.
We've seen a lot of developments lately, including in our company, where we are using big data, meaning over 10 years of data related to SMEs, balance sheet, and every information we have. And with this data, we try to model the probability of default with real elements. And it is actually pretty powerful to have a statistical sense of the risk you're taking when you lend to a small SME. So you can leverage on data to build maybe a robust scoring model, but I wouldn't rely solely on this model. I think data is a good way to complement a human analysis of an SME risk.
So it's really interesting. I think how data should be used when it comes to assessing risk with SME lending is that you should be looking at the full picture of the business. I think historically there's been a focus on the sort of traditional data, so financial operations data, which obviously is still what you should use. But I think looking at the 21st century and the amount of data that's now available to us, there's probably a lot of other data sets that you could use to build a fuller picture of a business. So if I give you an example, if you're looking at something like a hotel or a restaurant chain, then actually being able to look at data on sites such as TripAdvisor or Booking.com, seeing how many reviews they've had, how many customers tend to rate them out of 5 stars or 4 stars, what the feedback tends to be like in terms of customer service. If it's a restaurant chain, if lots of people are saying they've had food poisoning there, it's probably not a good sign. And those are things that I think historically banks haven't really looked at. They haven't delved into that level of detail. It's just been if the business is performing well and it's got sort of good footfall and things. So I think being able to look at some of those additional data sets could help to build a much fuller picture and a much more interesting picture as well.
Here again, it's twofold. One, the one I was just referring to, linked to the credit modeling, to try to have a sense of the risk you're taking. The other part is, to me, linked to the customer experience. You can use technology for a better scalability of every part of your process, from the decision-making process to getting the information. You can use API to get this information, put it in a structured way, go faster in your decision-making process, and automate your loan documentation, which is exactly what we try to do.
If you look at some of the platforms, particularly in Southeast Asia in the early stages, in the first piece is in the banking of the actual workers. So a lot of these platforms are fundamentally based on digital and electronic payments, and therefore they need their workers and customers to be banked. So in both Southeast Asia with the likes of Grab and Gojek, who've effectively set up neobanks in order to both service their end workers and then also to leverage the customers. And then in the US with Uber in particular, Lyft and others are doing similar. Uber a number of years ago was the largest source of new bank accounts in the US through one of their partners with GoBank, because they were onboarding, they were helping their drivers get bank accounts so they could get paid. And they've obviously recently announced some new services around Uber Money to start building on that.
So I think when you look at big tech and how they are moving into the banking and the fintech landscape, it's been happening a lot. I mean, you see it with a number of examples. Obviously, recently, Google announced they're going to be creating current accounts. We've seen it with tie-ups between JP Morgan and Amazon. We've seen it in tie-ups between Goldman Sachs and Apple. So there's a lot of big techs are kind of already in this space. Do I think they'd want to come in as fully regulated banks? Probably not. I think they'll go down the route of partnering with big financial institutions who can sort of deal with all the boring stuff and who can deal with the regulatory burden without these businesses having to deal with it. Instead, they'll leverage their brands, they'll leverage their customer experience, their UX to hopefully combine the best of both worlds and get access to a financial brand that people trust, or at least that they're aware of, and then combine that with their consumer brand that consumers love or that they tend to buy the product. So we are seeing it. How can fintechs and lenders and other financial institutions stay competitive? I think a couple of things. Some are choosing to do tie-ups with them, as we've seen with the likes of JP Morgan and Goldman Sachs. So, if you can't beat them, then join them and become an even stronger entity together. And I do think, ultimately there will be probably some fintech players, some new players who will not be able to scale as quickly as they perhaps have been historically as a result, because they're not sort of big enough to be interesting for the big tech players to want to partner with them. They're already finding it challenging to compete with the big financial institutions. If you then add on that those big financial institutions are now coupling with big tech, it makes that challenge even bigger.